let's talk a little bit about the concept of getting back in and how you know it's for real. Certainly, one of the things that has been a little frustrating here is that while the indexes have been really strong, specifically the Nasdaq. I mean, this was such a phenomenal January for the Nasdaq Composite to start the year. There are still those landmines out there. So maybe you could talk a little bit about that, Arusha. You know, I feel like for me personally, I'm seeing more stocks get up to 20%, whereas before it was like, oh man, if I had 10%, I better take it because it was going to, you know, get taken away from me quickly. I've had more go up 20%, but there's still a lot of stocks that just seem to get hit out of nowhere.
Yeah, it really this is not necessarily, even though with all those follow through days what we had, it's not necessarily an easy market, right? Mark
Mhm.
Minervini terms it, hard dollar, easy
Hard penny.
money. Hard,
Hard
sorry, yeah,
penny, easy
hard penny,
dollar.
easy dollar. Thank you.
Yeah.
Yeah, it's not an easy dollar just yet. It's starting to get a little bit better, but there are plenty of landmines out there, and there are plenty of stocks that are still kind of going up to 5% and not making a lot of progress. So it really
Right.
just comes down to your experience, and if you've been in some of those stocks that have had more trouble or aren't moving as fast, then maybe you don't have as much exposure, right? So it really just comes down to how you're doing.
Hmm.
And if you're making progress, if you're proving it to yourself just by the trading success, then that gives you more ability to have more exposure to the market. So it doesn't necessarily mean everyone, even though the markets had all this huge run on the indices, doesn't necessarily mean that we should all be on margin, right? Because
Right.
there have been plenty of stocks that have been tricky in this market.
Hmm. And it's important that we continually use the market as a feedback mechanism, right?
Right.
You put some money out there, and rather than putting it all in at once, because you never know if the market is going to work or not. The benefit that we have is that we can make incremental uh, bets. Basically, you can get in a little bit at a time, and as the market starts proving that your decisions are right and you're on the right track, then you put more out, and that's how you get fully invested, or even on margin when the conditions are right. And on the flip side, when you get keep when you keep on getting slapped down, rather than touching that hot stove over and over and again, you just back away a little bit and say, okay, you know what, I'm gonna ease my exposure. I'm going to wait and see if I can get some better setups. Maybe even do a quick little post analysis and say, hey, am I doing something wrong here, or is it just an effect of the market? And certainly when, like what happened in 2022, when you're below the 200-day moving average line, when you're below the 50-day line for so much of the time, you know that you're in a downtrend. You have to also change your rules, in terms of buying. You have to be more cognizant of defense and recognize that a lot of the patterns aren't going to work because it's a bear market. And that was something that Bill O'Neill was very vocal about, and wrote in big bold letters in his books. Loud warning to the wise.
Yeah.
A lot of the stuff that we're talking about here is not going to work in a bear market.
Yeah, and looking back in history, yeah, we theoretically, like when we had that March fall through day in 2009,
Hmm.
it really took like 4 months
Yeah.
before O'Neill type of can slim type of stocks really set up kind of our classic patterns that we look for, and then worked really well. So it was pretty tricky during that year. Or even in 2002, we had a follow through day in October of 2002 that worked for 6 7 weeks and then came back in pretty hard, and then eventually we had the March 2003 that ended up working a lot better, and there were a lot more bases in more of the growth type of stocks that were breaking out powerfully. So we might be in that one of those kind of phases where stocks are starting to act better, you're starting to make a little bit of progress, but it's not tons of stocks with great growth potential breaking out of perfect bases on powerful breakouts, and you kind of feel like that kid in the candy store. So I kind of feel like we're in that phase where we're setting ourselves up for an even better kind of run down the line.
Well, I'm glad you bring up that 2002 example. Maybe we could just kind of do a historical look there, because there are a few things that are, I think, worth noting in terms of some similarities. So if we go back to, maybe go back to like March '03, or, maybe even May of '03, because that can kind of show how March played out. And again, this is where the change date feature comes in real handy on MarketSmith, so you can kind of see what things looked like at the time. And yeah, this is a market where, remember, the Nasdaq Composite had come down 79% off of its peak. We had just a lot of this, um, these rallies, some very strong rallies, but the 200-day moving average line was containing the move, to the downside. Sound familiar?
Yeah.
And we
Yeah.
had, also, just so you know, in October of 2002, I'm looking at my spreadsheet right now. We had a follow through day on October 15th, 2002,
Yep.
and we had a number of subsequent follow through days. So we had one on October 17th, a little bit of distance, October 30th, November 1st, November 4th, November 6th, and then November 12th. So until this last one, that was a tie for some of the most subsequent
No
follow through
way.
days that we had.
So
Now,
Justin, okay, so how many were those right there in that
so
25 window? What
in
was
that
the number?
25-day window, so
Yeah.
you had the follow through day
Yeah.
plus 6 subsequent follow through
Okay.
days.
So total 7 there.
Yeah.
For this current rally that we're in, how many in that first 25?
So in the first 25 days, we had the follow through day and 7
So
subsequent follow
8.
through days.
So
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 a
we've had
total of
8 this
8.
time. We had
Yeah.
okay.
And then we actually followed it up with another day, but it was just outside of the 25-day window. So, I
Okay.
mean,
Okay.
Tuesday was another day that would have
Yeah.
qualified otherwise.
Yeah.
So we kind of labeled that an accumulation day, but you know, it still would have qualified.
Yeah.
Um, so we can also, kind of talk a little bit about the concept of the power trend. So again, remember the idea behind the power trend. There's a few things that we look at. The 21-day moving average line is above the 50-day, and the index we also like to see is trending above the 21-day line, so it stays above it for at least 10 days. And then we also like to see that the 50-day moving average line is above, or in an uptrend. So if it's in a downtrend, we're not going to call it a power trend. When you have those things in place, then we say, okay, this is something that um, could be special. This could have some lasting effects. And in this case, the power trend did start. We did get a power trend that started on November 4th. So we had that follow through day. And then by the time November 4th rolled around, we
Mhm.
had all of the elements of a power trend. And look, so we had all of those subsequent follow through days. We had a power trend that started. By the way, we had a power trend start in this latest rally too. Um, but then we were still below the 200-day moving average line,
Right.
and once we got there, we we kind of came in. Now that
I mean, that was
October
almost
low,
classic, right? Because you had
right?
the
Yeah,
downside
exactly.
reversal and came in. Yep.
Yeah. So we had the October low that did hold,
Hmm.
and then Bill was very keen on the 3 waves down that got formed at that point. So you had that rally into the 200-day line. You had a single wave down, back to the 200-day line, another wave down, and then you didn't quite get up to the 200-day line, but you had another leg down. And one of the things he noticed was that the volume was starting to kind of pick up on the positive side, and be a little bit less on the negative side. So what ended up happening is the accumulation distribution rating for the index, the Nasdaq Composite, ended up switching to an A, or like I think it was like an
Wow.
A minus. And then you had the follow through day that occurred on um, March 17th,
Right.
'03, and that's the one that worked. Now it didn't go straight up; it went kind of sideways for a little bit, but then this is where you had the real power and what really kind of started the bull market that lasted uh, really through the until the great financial crisis. Not straight up the whole time, but certainly a lot of power behind it.
Yeah, and and that March 17th, I mean, I clearly remember because that was really kind of the first follow through day that I really saw
Hmm.
following the system, and that was the same day that we went into Iraq, uh,
Right.
and and that always kind of just blew my mind that everyone's worried
Yeah.
about what's going on there, and here's the market going, hey, it's a signal to buy, right?
Yeah.
So it's the markets are always going to go do the opposite of what you're hoping. The news was the worst, and the markets are turning at that time.
Hmm.
Kind of like, that's so that you always want to keep that in mind because the news, when you look at from a macro level, it's pretty bad, right? You're
Hmm.
starting to see we just saw on Twitter right now that Disney's laying off 7,000 people. You're seeing all these layoffs and uh, the things, I guess, from a larger perspective are getting worse and worse.
Hmm.
Uh, but the market a lot of times will kind of discount that in and turn when everyone doesn't expect it.
Right. You know what? One more example that we can show that was also during this kind of bear market, this really horrible dot-com crash that we had. If you kind of go back a little bit earlier, and we've talked about this, the September 11th, tragedy happened in 2001, but shortly after, there was a very powerful rally. This rally was, a
Yeah.
40% move in the index, and granted, it was short-lived. It didn't work ultimately, but this is another case where you had the follow through day was on the 28th. So you can kind of see where the 9/11 tragedy happened. The market was closed for 4 days. We went lower after that, so the gap was a little bit earlier than that, 4 day gap where you see kind of the
Hmm.
space. We ultimately bottomed out. We had our follow through day on the 28th, and then a subsequent follow through day on October 3rd, another one on October 10th, October 11th, October 16th, October 24th, October 25th. So another one where
Wow.
we had a follow through day plus 6 subsequent follow through days. And, you know, again, it was kind of showing you that the market was, whether it was short covering, whether it was, just a lot of buying, I mean, almost patriotic buying at the time. People were like, we want America to live and
Right.
show our faith and everything like that. Now, in this case, we didn't get a power trend until November 19th of '01. That's when I think you had the 21 day above the 50 day for a while, and you just didn't have the low staying above the 21 day, and you also had to wait for that 50-day moving average line to kind of turn into an uptrend. So you can see how it was kind of flattening out, and then it had
Yeah.
to turn into an uptrend. So the power trend did come later on this one, November 19th, and it was short lived. The power trend only lasted until January 28th. '02, and you did make some progress above the 200-day moving average line, and it looked like you were holding above there for a while. This was looking promising,
Right.
but it ultimately did fail and go to new lows. That's not to say that that's what's going to happen this time, but I think you have to hold that scenario in your mind that that is possible. It is possible that maybe the soft landing doesn't happen. Maybe inflation gets entrenched. There's a lot of maybes behind it, but you have to still have your risk management rules in place because we haven't gotten the all clear signal.
Yeah, and I think that's why the day by day, week by week approach is the most realistic one to stay on top of the market, right? Where you're just kind of taking the new evidence that comes in and letting that guide you. And you're looking at the markets, whether they're above these key moving averages, where in the power trend, and then you're also looking at those stocks, whether some of the stocks that you've bought, you're actually making progress or not. And I've always found that that's just kind of the the best way, and so the market will slowly pull you in, and slowly push you out.
Mhm.
If you're kind of just using those basic metrics to tell you how much exposure to get in or not.
Right, absolutely. One more example, and we'll go ahead and kind of, wrap up this learning lesson. But I also wanted to kind of show 1991, because I mean this was the start of uh, such a beautiful bull market. So if we kind of go back to, I mean, you can go back to 1992 to kind of give some sense. But the follow through day that we will start with is on the 23rd of January in 1991. And this is another case where you just got immediately a lot of evidence. So kind of like what we saw this last time, you had a bottom, you held above the bottom, but in this last instance, we came down a lot more. We came down a lot closer to our October lows. We didn't hold as well. But in 1991, we arguably were in a little bit of a stronger spot to start. And we had the follow through day on January 23rd, a subsequent on the 24th, another subsequent follow through day on the 30th of January, then on February 4th, February 5th, February 6th, and then another one on February 11th. And so, and then you can see it didn't stop there. I mean, this was just,
Yeah.
that was nuts.
And this was
So
this was the Iraq War One.
yeah, Persian Gulf. So
It going in Kuwait, right? Iraq going
mhm.
into Kuwait.
And then we did have a power trend, of course, that started here. The power trend started on actually it started before that follow through day. It started on the 12th of December.
Wow.
So back there. So basically, what had happened is it kind of we had enough distribution and everything like that to kind of reset to where we needed a new follow through day.
Hmm.
And but the power trend remained intact in this case, and you can see we actually ended up getting support at the 50-day moving average line. So this was a definitely in a different position this time around, a stronger position. But again, if you go forward, to 1995 and look at the weekly, you can see what kind of power started here. And this power trend, by the way, lasted until June of 91 before it got into a little bit of trouble. But overall, this was just such a powerful market, one of the best that we'll ever see. Unfortunately, I was in high school when it started, so I
Exactly.
didn't participate.
Neither of us did.
Yeah. So anyway, any final thoughts on kind of the subsequent follow through days and the power trends, some of these historical examples that you want to note here, Arusha?
I think when you use objective signals like this, that's what's going to help you get in around the right time and stay in,
Mhm.
uh, because your psychology is not going to be in the right place during when the markets are turning. You're just going to be so used to, just like we've been used to over the last year, just seeing everything not work.
Yeah.
And so when you see kind of all these indicators saying, hey, we might have a chance here. It's not 100% guarantee, but we might have a chance here. And you're using the follow through day, additional follow through days, and the power trend, that at least is going to put history on your side,
Mhm.
and just kind of let the markets and let these signals guide you how much exposure. And then of course in the end, it's your portfolio and how
Yes.
you're making progress, and obviously cutting your losses when things don't work, because as we saw in some of these examples where, hey, you got over the 200-day, things are looking really good, and then all of a sudden it turns around for whatever reason and undercuts, and now you're back in the downtrend, and you have to wait another 3-4 months before something else sets up.
Mhm. And Arusha, you've said it a couple times already, but I'm just going to go ahead and repeat it. It's not just about the indexes. It's also you have to look at those individual stocks and your portfolio and the progress you're making and stuff like that. Because, sometimes growth does take a little bit longer to come on. And so you might not be making the progress immediately because it's things coming off the bottom and the bottom fissures and the short covering that kind of drives it forward at first, before the growth names finally, get their setups, get their cups with handles and everything like that. So
Yeah, and one more thing, Justin, I would say that, but we are in that time right now where you have all these signals where you want to on the weekends try to do a little bit more work building up those watch lists, and becoming familiar with some of these stocks that are doing well, because they could be the next leaders
yeah.
of a potential new bull market.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.